Which of the following is a key reason why equity investors demand a higher return compared to debt investors?
Here are your options. A. Equity investors have a legal claim on company profits. B. Debt investors do not receive fixed interest payments. C. Debt investors are more affected by market volatility. Or D. Equity investors face higher risk due to uncertain returns.
Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Equity investors take on higher risk as they receive returns only after all obligations are met, whereas debt investors get fixed interest payments regardless of company performance. Which of the following correctly describes the difference between a bond and a debenture in India? Here are your options. A. Bonds are issued by public sector organizations while debentures are issued by private companies. B. Bonds are issued by private companies while debentures are issued by the government. C. Bonds are short-term securities while debentures are long-term securities. Or D. Bonds are unsecured while debentures are secured. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. In India, government and public sector organizations issue bonds, whereas private sector companies issue debentures. What happens if a company defaults on its debt obligations? Here are your options. A. Equity shareholders lose their dividends permanently. B. The company's credit rating improves. C. Debt holders may take legal action and claim company assets if the debt is secured. Or D. The company must immediately issue more shares to raise funds. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Debt holders, especially secured lenders, can claim company assets in case of default, whereas equity shareholders have no such claim. Why are government securities considered risk-free investments? Here are your options. A. They offer the highest returns among fixed income securities. B. The government can always print money to repay its debt. C. They have a fixed interest rate that never changes. Or D. They are not affected by inflation. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Government securities are considered risk-free because the government can raise taxes or print money to meet its obligations. Which of the following is not a characteristic of hybrid securities? Here are your options. A. They combine features of both debt and equity. B. They are suitable for investors with a moderate risk appetite. C. They may offer fixed or variable returns. Or D. They always provide voting rights to investors. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Hybrid securities, such as convertible debentures, may not always provide voting rights like ordinary equity shares.